I want to take some time and talk about my favorite topic to hate on, which are target date funds. My personal, professional, financial advisor opinion, you should never ever buy these. These, to me, are the epitome of how a bank teaches you to settle for less. And in my personal, professional opinion, these only benefit the bank. And I'm going to show you exactly what I mean by that. When I first got started, when I first got licensed, I was taught to sell these. I was actually only allowed to sell these or some variation of them. They weren't a target date fund, but they would say something like moderate growth allocation model or growth allocation model or something like that. And even back then, I could see that these were not in the best interest of my clients, not if I really wanted them to make money. Okay. And I'm going to talk about what these things are, and I'm going to talk about what these things aren't. So what they are is they are an over-diversified portfolio of stuff you just don't need. And your returns suffer so significantly in the short term and the long term that I cannot see it how these would ever be in your best interest. I have to operate as a fiduciary, which means I put my client's interests ahead of my own. I'm also going to put my client's interests ahead of the bank's. And to me, these types of investments only benefit the bank. I'm going to pick on Vanguard, but it really doesn't matter what company it is. It could be T. Rowe Price is actually probably the best, but they still have the same problems. Franklin Templeton, American Funds, Capital Group, it doesn't matter. It's the same car driven by different companies. And let's just take a deeper dive into these, and I'm going to show you exactly what I mean. This is the Vanguard 2025 fund, the more conservative fund. And what these things are designed to do is if you are retiring in 2025, they're basically saying, hey, this is the fund you can invest in. And a lot of times, these are the default funds in your 401k, which is just a big, big no-no. You need to switch that to the S&P 500 index fund. That's almost always offered in 401ks. But these are the default options. So if you haven't manually gone in there and changed your 401k options to the index fund, you're probably in one of these and you're suffering. You're probably getting 6% when you could be getting 12. You could be getting double. In terms of retirement with all the years and compounding, that's hundreds of thousands of dollars that you're wasting. I'll show you that in a second. But let's take a deeper dive into these. So they're low expenses. That doesn't really matter. It doesn't really matter if a fund has 0.1% expenses or even a 0.5% expenses, to be honest with you. And the reason I say that, I'm not saying that fees aren't important. They are. But at the end of the year, if you're up 12.1%, are you mad that it's not 12.3? Are you mad that it's not 12.5? You probably don't even care about the 0.2 or the 0.3. When we talk about, I'm not saying they shouldn't be a conversation, but it shouldn't be your biggest conversation. I would rather pay 1% and get 5% more than pay a lower fee and get a pretty crappy return. And a lot of people are doing that. They're so concentrated on fees that they're not looking at performance. You can pay for performance. That's okay if you're getting your money's worth. Let's look at these. So year to date, it's at 5.46%. Not too bad. Let's check out the overall performance of these things. 3-year average, 7.37. 5 years, 7.32. 10 years, 6.39. And since the inception, this thing has a 22-year track record of earning less than 7%. Now, why that's important, that means your money doesn't even double. It's not even going to double every 10 years if you decide to invest in this particular fund and many others. Many others will have the exact same return. And these things are really just designed to benefit the banks. And here's why. These funds are a collection of just other funds that banks and investment firms put together. Look at this. It's a Vanguard 2025 fund, but it's basically just made up of 5 other Vanguard funds. And this is the exact same, again, whether it's a Franklin Templeton fund or an American Funds or Fidelity, it doesn't matter. It's just a culmination of other funds they already offer. And that's very, very important to realize. And here's the problem with these things. So 30% of your money is in the Vanguard Total Stock Market Index Fund, which is basically the US market, but it's very diversified. It's probably about 5,000 stocks in that. You have a third of your money that, not quite a third, but almost a third of your money that's in bonds, which just isn't going to grow because bonds have just been a terrible investment for the past 20 years. I know someone's going to tell me, oh, it's diversified and you need to have it to balance out your portfolio. No, you don't. You absolutely do not need to have bonds to balance out your portfolio. You don't need to balance out your portfolio probably until your 70s, honestly. That's one thing I've learned is that people go way too conservative way too soon. If you're in your 60s, you're probably going to live to your 80s or 90s, which means you've got 20 or 30 more years to invest. You're not, hopefully, dying tomorrow. You don't need bonds that early. In my opinion, you don't need bonds at all to 65. And even then, real estate is probably better for you, or gold. The 20-year average on bonds is between 2.5%, 3% right now. And that's only because in the last year, we had some 4% treasuries. So you're bringing up the averages a little bit, but bonds are a terrible investment. We'll just take a look at this one, see at the performance of it real quick. Performance. Look at this. Over 5 years, you've lost 1%. That's your 5-year average. You've lost 1%. 10 years, you're up 1.4. For 15 years, you've earned 2.5%. If you earn this fund for 15 years, you have averaged 2.5%, which is not keeping up with inflation at all. At all. Let's go back. Here's the other problem. You have way, way too much money in international stock. International stock markets do not perform. I'm going to argue this until the day I'm proven wrong or the day I die, whichever one comes first. Here's what a lot of people say about international markets. It's always the same explanation. Well, the US isn't always the best. So, yeah, that's true. But the thing is that no other country is consistently outperforming the US. You might have Greece that's up 43% in a year, but it won't hold that trajectory. You might have Ireland up 27%, but it'll only be at 5% the next year. Plus, you're also not realistically going to put a large enough chunk of your money into Greece or Ireland to make an overall impact of your portfolio. Let's take a look at this. And again, we're just looking at performance. We're not looking at diversification because you have to really question diversification because it can diversify away your portfolios. Charlie Munger's a really big fan of that, saying it's called diversification. For some reason, that wouldn't come up. Hold on. So here's the total international stock index fund from Vanguard. And again, we're just going to look at performance real quick just to see what it does. 5-year doesn't look too bad, but the 10-year and for the last 15 years, you've been earning 5.5%, which is roughly probably keeping up with inflation. But here's the thing. You've invested internationally. You've got different political risk. You've got currency conversion risk, just all kinds of different risks. And you're not making more than if you just would have kept it here at home in the States. And this isn't me being patriotic. This is just me looking at the numbers. For 20 years, I've been looking at the numbers and saying international funds just don't outperform. And not even outperform. They just don't even keep pace. Let's look at the composition of the portfolio geographically. So we have 26% in emerging markets, 40% is in Europe. So that means that your money is divided between all these different countries. One may be doing better than the US, or even 5 may be doing better than the US, but you have 17 that aren't. Again, you diversify away the portfolio. And realistic, I just read an article that Greece's market is doing incredible right now. But you're not going to put a ton of money into Greece. You're not going to take on that additional risk. And when the US is doing 10 or 12, but an overall diversified mix of international stuff only gets you 5.5, just stick with the US. It really is that simple. You don't need emerging markets either. Emerging markets is the same thing. For 20 years, I've had salesmen, mutual fund guys, ETF guys saying, oh, emerging markets is the next big thing. Emerging markets, it's never, ever panned out. Ever. Again, it's too diversified. There's too many moving parts. There's too much stuff going on. And a lot of those countries, they're not overly capitalist. The US is. That's the key thing too. They're not profit driven. Okay. The US outperform the US because not that it's more of a socialist country, but it's not a capitalist country. Same thing with China. China, there's certain stocks that are going to outperform the US, but as a whole, probably not. It might do it 1 year, might do it 2 years, but it's not going to do it consistently. So when we're going back here, we don't need these funds. We don't need this bond index. We don't need this international. We definitely do not need international bond index. The only reason to keep short-term treasury, this is an alternative cash position. So professionally, 70% of this fund is holding you back. That means 7 out of every $10 that's invested in this fund is either underperforming, or at best, 3 of those dollars is getting 5.5%, because the rest of these aren't making that. Absolutely not. Absolutely not. So here's the other thing I don't like about these. In the same way, they're going to have pretty much the exact same holdings. And the idea is that, hey, if you're going to retire in 2060, the portfolio will automatically get safer as you get older. I call it the lazy man portfolio. But that's a terrible, terrible idea, because one, you're still going to need growth in your retirement years. I don't care who you are, you're still going to need growth in your retirement years, because you need to keep up with inflation. There's always some world event that happens that devalues your dollar crazy. You need to have stock. Again, this is a financial advisor with 20 years of experience actually working with people, not just an influencer who hasn't been held accountable to anything, but someone who's actually worked with people and seen their life. I've had clients in their 60s, 70s, 80s, clients that have passed away on me. I know how it goes. You need stock. And furthermore, so because this fund automatically begins selling investments, it'll start selling your stocks and moving more into bonds as you get older. They take into no account the timing or the economic conditions while this is happening. Okay? So what if they start doing that in a year like 2008? Or they start doing it during a COVID year or a period of high inflation, or they just start buying bonds at the exact wrong time to be buying bonds. It could be an interest rate risk or credit risk or something like that. But there's times to buy. I don't think there's really times to buy bonds at all. But if you're going to buy bonds, there's certain times to avoid them, certainly. And you don't want to be caught in that cycle by owning this fund and having them do it for you. Furthermore, let's take a look at something very, very interesting that a lot of people don't know about. And this is what blows my mind the most about these. I'm going to pull up these funds, 40, so on and so forth. So check this out. This is what kills me the most about these things. I don't understand. Again, we're just going to look at the returns. We're going to scooch this over so we can view this a little easier. We'll start with 2025. So if you're retiring this year, here's your average return, 6.74%. Let's just fast forward to someone who's retiring in 2050. They're barely getting 1% more than the person that's retiring today. How does that make any sense? How does that make any sense? And it's just so on and so forth. Look at this. 2035, 6.39. Okay, we get up to 7%. Then we get up to 7.5%. So someone who's retiring 10 years from now is making a little bit more than 1% more. You get to 2040, you're finally cracking 8. Again, you're not even keeping pace with the index, not by a long shot. You're finally cracking 8 at 2040. There's a 15-year difference here. There's another, we'll just go from 2040 to 2060. Look at this. 8.11 to 8.79. You're getting a little bit more than 0.5%, and you're retiring 20 years longer in the future than this guy who's retiring now at 2040. How does that make any sense? The returns are all the same. These are terrible, terrible investments for anyone to have. I don't care what data is presented to me. The returns aren't great. In my personal opinion, they're terrible, because you can get 10 to 12 buying VOO. Throw in some gold or throw in some Bitcoin. Bitcoin's an incredibly safe asset now. It's volatile as hell, but the richest people in the world are now investing in it. Or just buy the triple Q. I did a video on that just the other day about buying the triple Q. It gets you 15 to 17%. Then you can throw in a bond fund, because you can sacrifice to earn some. You can sacrifice a few percent when you're earning 15 to 17%. But these things, why? How? Why are these the default options in your 401k plan? And there's a story behind that. I'm going to tell you, and it actually has to go back to 2008. I won't tell it in this video, but I'm just telling you now, if you have these funds and if you have a 401k, I almost guarantee that you do have one of these funds. And everyone that has these funds always says the same thing. Well, it's doing pretty good because you have no reference point. You don't understand that if you're younger right now, if you're going to retire in 2060, that is 25 years from now. So you're 35 years old and you're going to settle for making 0.5% more than someone who's going to retire in 2040? You've got to be out of your mind. That is ridiculous. That is absolutely ridiculous. Don't settle for that. I mean, you talk about not wanting to pay financial advisors, but this is the stuff that's killing you with its underperformance. This is what's killing your retirement, your returns. I would much rather have someone pay 1% and put me in the triple Q where I'm getting double this return than this that only benefits the banks because you're buying more of their product. It's just packaged differently.